those who've been following us have probably seen this before, but this is just again like stepping back and from a fundamental framework perspective, understanding what moves the markets are really largely two dynamics, right? You got your growth dynamics and your inflation dynamics. And different asset classes are going to do differently, whether we're in a period of accelerating growth versus decelerating growth, or accelerated inflation or decelerated inflation. And when you look at the vast majority of portfolios today, we see almost everybody really hovering in that bottom two quadrants, mostly in the bottom right quadrant, which is the requirement to thrive in that environment is benign inflation and persistent growth shocks. And what does well in that environment is developed equities and developed bonds, right? And so that's where we are today. That's what we've been for the last 10 years. And the question is, if we are in an inflationary regime, I don't think we even have to question that. We have seen inflation, and what we've seen perform really well has been what is expected in this framework, which is in a rising inflation environment, commodities, gold, tips are going to be decent offset. And,
emerging equities are interesting too. I mean, emerging equities
yeah.
as of yesterday, I think it was yesterday, they were up on the year, right? Mm-hmm. While developed markets are down sort of 5 to 10% or more. So,
and this is one of those interesting things from a decade-long experience. You know, if we went back to 2000, U.S. equities had done so well. And then from 2000 to 2010, 11, 12, 14, U.S. equities have really struggled. What did well? What did well? Emerging markets did well. The Canadian resource economy did well. The currencies related to those types of countries did well. International real estate did well. And so, you know, we're in a situation where if you look at, you know, the last decade of returns and valuations on, let's say, U.S. equities that represent that disinflationary growth quadrant, they've pulled a lot of those future returns into current valuations. Contrast that with emerging markets over the last 10 years, you know, much better valuations. Price action has not been great over the last decade. And so they haven't pulled those future returns into today. So if we're thinking about, you know, how is this going to be over the next 10 years, as you mentioned, Rod, like where's the puck going to be? You know, you have to make those considerations when you're making your allocations.
Yeah. Exactly. And I think, you know, let's take a look at the empirical data. So we just said theoretically these asset classes should do well in an inflationary regime. Let's kind of go through some of Mann's conclusions from that same paper and just take a look. Which asset classes do well, which asset classes struggle. If I can find it here, let me share the screen. Okay, so again, this is going back to 1926, and the two columns to look at here is the periods of inflation on the right-hand side here. So when they looked at the 1926 to now period, they found that 19% of the time we've been in an inflationary regime, and the other 81% of the time it's other, right? And as expected from that framework, you're seeing the best performing asset classes, energies, right? And I think a lot of that has to do with, you know, looking at the 70s, that was a big player, the energy space. Is that going to be the case in the future? We don't know. I think we talked a little bit about this. Other kind of long-only asset classes, again, commodities, industrials, aggregate commodities, gold, precious metals. Those are kind of from a passive allocation perspective. We'll talk a little bit about the other categories here, which is trend, all asset trend, commodity trend. Those tend to do really, really good job during inflationary periods. And then the big losers are, again, what we expect, right? Consumer durables, long equities is going to struggle. Long duration fixed income, you know, the 30-year treasury had in that inflationary regime an annualized rate of return of -8%. You know, high yield fixed income, -7%. The 10-year treasury, -5%. What else are we looking
Interesting,
at?
residential real estate. I think a lot of people have a perception that owning a home is good protection against inflation. And in fact, if you look back historically, all the way to 1877, I think this goes, the residential real estate has delivered a return of negative 2% annualized during inflationary periods. And I would argue that given the current structure of residential real estate, where loan to values are much, much higher in the current environment than they were in other inflationary periods, and we're starting from a much lower initial rate, I would argue that the real estate market, residential real estate, is as vulnerable as it's ever been right now to rising rates. And I think a lot of Americans perceive that because you're able to get a 30-year mortgage, that offers protection. And to some extent it does. But what it means is that the ability to get credit to buy your home, for someone else to buy your home, it gets more and more difficult, right? So, for example, if I go back to 2019, the average the average monthly payment on a new mortgage in the U.S. was about $1,700. The average payment at the end of 2021 is about $2,200. And that's a combination of larger mortgages on average and higher rates on those mortgages, right? So what it's going to have an impact on primarily is labor mobility and new household formation. So young people are just not going to be able to afford to own homes. They're less likely to have families, or they'll delay having families. They'll have fewer children. So these are not insignificant challenges.
Yeah.
And the prices are not going to go up for a year.
So you have price volatility in the underlying asset. I suppose some of the inflation hedge on the residential real estate side comes from the fact that if you've owned your home and you've paid it off, or you have this locked in payment, then your cost of living has a slightly reduced exposure potentially than if you're a renter. So there's a portion of it that can help. But it again, if you're offsetting that, but if the price is declining, your balance sheet, your personal balance sheet isn't improving particularly. But you've got a bit of a hedge there.
And those home equity line of credit, they get cheaper, they get harder to get. The collateral that you can use on the house is lower. Like there's lots of ways that it affects the economy. And like I said, historically, the residential real estate has just not been a very good inflation hedge. Negative 2% annualized returns during previous.